Your parents told you to buy a house. They said rent is throwing money away. They said homeownership is the only path to the middle class. They said if you work hard and save, you can afford it. They were right. In 1970, a median single-income family could afford the median home using just 25% of their income. One paycheck, one parent is working, one income buying a house, raising kids, and saving for retirement. Fast forward to 2026. Home prices have doubled relative to inflation since 1970. Wages? They've barely kept pace. The math that worked for your parents doesn't work for you. I'm Sam, and I'm about to answer the question everyone's asking, but nobody wants to confront. Who can even afford a house in 2026? The brutal answer? Almost nobody. And the people who can are often making a catastrophic financial mistake by doing it. By the end of this video, you'll understand why home ownership has shifted from an asset to a leverage-fueled consumption purchase masquerading as an investment. Let's start with the raw data, the numbers that nobody wants to talk about. The median individual worker in America earns about $52,000 per year before taxes. Sounds decent, right? Wrong. After federal taxes, state taxes, and FICA, that $52,000 becomes about $37,000 take home. That's $3,083 per month to live on. Now let's look at what housing actually costs. The average household housing expense in 2026 is $1,885 per month. That includes rent or mortgage, utilities, and insurance. $1,885 out of $3,083 is 61% of take-home income going to housing. You're already in the suffocation zone, spending over 50% on housing before buying a single calorie of food. But wait, you also need transportation. The average American spends $913 per month on car payments, insurance, gas, and maintenance. Housing plus transportation, $2,798 per month. You have $285 left for food, healthcare, student loans, childcare, savings, emergencies, and actually living your life. This is the median American worker in 2026, and we're telling them to buy a house? Stop. Let me show you what actually happens when this person tries to buy a $400,000 house, which is below the median home price in most markets. They scrape together 10% down, $40,000. They finance $360,000 at 7% interest. Their mortgage payment is $2,395 per month, but that's not their total housing cost. Add property taxes, $400, insurance, $200, maintenance, $333, and utilities, $250. Their actual housing cost is $3,578 per month. On a $3,083 monthly income, they're spending 116% of their take-home pay on housing alone. This person cannot afford this house, not even close. But people are buying anyway. How? Dual incomes, massive debt, family help, and financial stress that's invisible on Instagram. Now let me perform what I call an amortization autopsy on that $2,395 mortgage payment. This is where we dissect where the money actually goes. Month 1, they send the bank $2,395. How much of the house did they actually buy? About $285. The other $2,110? That's interest vapor, unrecoverable cash paid to the bank for the privilege of renting their money. 88% of the payment is throwing money away to the bank, but nobody calls it that. They call it building equity to feel better about it. Over the first year, they'll pay $28,740 in mortgage payments. They'll buy about $3,420 worth of equity. The other $25,320 is interest vapor. That's more than most people pay in annual rent, but renters are the ones throwing money away. For the first 10 years of a 30-year mortgage, 70% to 80% of every payment is interest vapor. You're not building equity. You're the bank's most profitable tenant. And here's the brutal twist nobody's talking about. Mortgage rates dropped to 6.3% this year. Everyone celebrated like it was some great victory. Finally, rates are coming down. Wrong, dead wrong. Because while mortgage rates dropped, insurance premiums exploded. In states like Florida, Texas, and California, homeowners insurance has increased so dramatically that it's effectively added the equivalent of a 2% interest rate hike to your monthly payment. You thought you were getting a 6.3% mortgage. After insurance, you're effectively paying 8.3%. The rate drop was a mirage. Insurance companies just absorbed the savings while homeowners got hammered from a different direction. In Florida, annual insurance premiums have jumped from $2,000 to $6,000 plus for the same coverage. That's an extra $333 per month that wasn't in your budget. In California and Texas, it's nearly as bad. So that $2,395 mortgage payment at 6.3%, add the real insurance cost, and you're at $2,728. You're paying 8% plus equivalent after accounting for the insurance crisis. The rate improvement was completely erased by costs the bank doesn't advertise. But here's where it gets even more brutal. Let me introduce you to the credit tax. Two people want to buy the same $400,000 house. Buyer A has excellent credit, 780 score. They get a 6% interest rate. Monthly payment, $2,158. Total interest over 30 years, $417,000. Buyer B missed one mortgage payment 3 years ago. Their score dropped 180 points to 600. They get a 7.5% interest rate. Monthly payment, $2,517. Total interest over 30 years, $546,000. Buyer B pays an additional $129,000 in interest vapor over 30 years for the exact same drywall, the exact same roof, the exact same patch of grass. This is the credit tax, wealth transferred directly from the worker to the banking cartel because an algorithm from 1989 said so. One missed payment, one mistake, $129,000 stolen from your future. Now let me show you why dual-income households feel broke despite making $100,000 plus. In 1970, one income was enough, but then something changed. Women entered the workforce in massive numbers. Suddenly, households had two incomes instead of one. Did families save that extra income? No, they used it to bid against each other for houses in good school districts. Family A can afford $400,000 with two incomes. Family B bids $420,000. Family C bids $450,000. The price keeps rising until it absorbs every dollar of both incomes. This is the arms race for educational opportunity. Everyone's running faster, but nobody's getting ahead. Home prices rose to consume the second income, and now families need both incomes just to afford what one income used to buy. And here's the trap. In 1970, the stay-at-home parent was a safety valve. If the breadwinner lost their job, the other parent could enter the workforce. The family had reserves. Today, both parents are already working. Both incomes are already committed to fixed expenses. There are no reserves. If either partner loses a job, the entire structure collapses immediately. Families are running at 100% capacity with zero margin for error. One layoff, one medical emergency, one bad Tuesday away from financial catastrophe. So who can actually afford a house in 2026? Let me give you the forensic tool to figure it out: the price-to-rent ratio. Take the home price and divide it by annual rent for a comparable property. Example, $400,000 house. Comparable rent is $2,000 per month, $24,000 per year. Price to rent ratio, 400,000 divided by 24,000 equals 16.6. Here's the rule. If the ratio is above 20, the math screams at you to rent and invest the difference. Why? Because at ratios above 20, you're paying a huge premium to own versus rent. You're better off renting the housing service at a discount while investing your capital in assets that actually compound. Let's compare two people in a market with a 25 price-to-rent ratio. Person A, the owner, buys $500,000 house, 10% down. Total monthly cost, $4,200. Mortgage, taxes, insurance, maintenance. After-tax income needed, $8,400 plus to stay under 50%. Down payment, $50,000 in debt equity. Person B, the renter, rents comparable house, $2,500 per month. After-tax income needed, $5,000 to stay under 50%. Invests the difference, $1,700 per month. After 30 years, the owner owns a paid-off $500,000 house, has maybe $150,000 in other savings. Total net worth, approximately $650,000. The renter invested $1,700 per month at 10% for 30 years. Investment portfolio, $3.8 million. Total net worth, $3.8 million. The renter has $3.15 million more wealth by renting in a high price-to-rent ratio market and investing the difference. This is why the question isn't who can afford a house. The question is who should even want one? Because here's what nobody tells you about that down payment. It's dead equity. $50,000 locked in walls where it cannot be rebalanced, produces no dividends, and cannot be used for opportunities. It's a prison of illiquidity. If you invested that $50,000 in the S&P 500 instead, 10 years, $130,000. 20 years, $337,000. 30 years, $872,000. That down payment you're so proud of just cost you $822,000 in opportunity cost. Meanwhile, the S&P 500 has averaged 10% annual returns for decades. Your house? Maybe 4% if you're lucky, and that 4% is trapped behind a 6% exit tax in realtor fees if you want to access it. So let me answer the question, who can afford a house in 2026? 1. People making $150,000 plus in household income who can keep housing under 30% of gross income and still have margin for life. 2. People in low price to rent markets, under 15, where buying actually makes mathematical sense compared to renting. 3. People who understand they're buying a consumption item, not an investment, and are okay with that trade-off. Everyone else, you're either stretching beyond what you can afford or you'd be better off renting and investing the difference. And here's what you need to understand. The real wealth isn't in the house. It's in what I call the liquid empire. Assets that work for you, not assets that consume you. $100 per week invested at 8% creates $1 million portfolio in 36 years. That's $14 per day. Less than lunch and coffee. Most people can't invest $100 per week because they sank their capital into a house and now spend 60% of their income on housing costs. They chose dead equity over compounding wealth. The true flex in 2026 isn't the house you can barely afford. It's being a liquid millionaire, someone who values optionality and mobility over a 30-year prison of illiquidity. The homeowner is anchored, one zip code, one job market, paying the bank $2,000 plus per month in interest vapor, trapped by the exit tax, no reserves, maximum stress. The liquid millionaire? They can move for opportunities in 30 days. No exit tax, capital compounding at 10% in the market, optionality to quit toxic jobs, actual wealth instead of the performance of wealth. So here's what I want you to do. Run the forensics on your own situation. Calculate the price to rent ratio in your city. Calculate what percentage of your income would go to housing. Calculate how much interest vapor you'd pay in the first 10 years. Calculate what investing the difference would become. Then ask yourself, am I buying a house because the math supports it or because society told me I'm supposed to? Drop your price to rent ratio in the comments. Tell me your interest vapor number. Let's build a database of where homeownership makes sense versus where it's a wealth-destroying trap. Who can afford a house in 2026? Almost nobody. And most people who can shouldn't want to, not when renting and investing builds exponentially more wealth. The goal isn't to own a deed. The goal is to build a liquid empire that gives you freedom, options, and actual wealth instead of the illusion of stability. If you enjoyed this video, hit the like button, drop a comment, and subscribe to this channel. See you on the next one.